Mr. Vinyals, thank you very much for being with us.
You're welcome.
In this GFSR, you look at two types of risks: financial risk-taking and economic risk-taking. Don't we need those two types to get the recovery going?
Yes, that's right. You need both to support the economy, both the economic and the financial risk-taking. But what we're seeing at the global level is a dissonance between economic risk-taking, which is lower than we would like in terms of firms being willing to invest, to hire workers, to produce more, and that is something that would be very good for growth. So we're seeing too little of economic risk-taking, but we're seeing some excesses in financial risk-taking, which if left unaddressed could eventually compromise financial stability. So it's a matter of rebalancing. You need more economic risk-taking for growth, and then you have to keep financial excesses under control in order to preserve global financial stability.
And what is your message on banks?
My message on banks is both good news and also not so good news. The good news is that banks now have become much stronger as a result of the important work that has been done, higher capital, lower leverage, and so on. But the not so good news is that banks in a number of countries may not be yet in a strong enough position to vigorously support the recovery when it takes place through credit creation. That doesn't mean that the banks are not safe, but that maybe don't have the capacity to provide as much credit as is needed. There is 40% of the banks which have low profitability in a rather persistent manner going forward, or some of them which may not have sufficiently large capital buffers to re-risk their balance sheets through lending. So these are banks that need to do work. They need, in particular, to change their business models to adapt to the post-crisis realities, and that's something which is required for these banks to support the system. It's not that they're not safe, they are, but they need to do more. And this is like when you come from the doctor from a medical checkup and you get a clean bill of health that tells you you can now lead a normal life. But if you're an athlete, this is not enough. You need more in order to be able to run and to perform at the high level that you want. That's what is needed now.
Why should policymakers be concerned about shadow banks?
The good news is that shadow banking can support the economy through financing, complementing what banks do. And that is very important. This is where the United States is now. This is where Europe would like to be. But the not so good news is that shadow banking entails new sources of risk, risks which have to do with the informational problems that we have to understand what's going on in the shadow banking, and the fact that regulation is not there yet in an appropriate manner. To give you an idea of the orders of magnitude which are involved here, if sovereign bonds were to go up in terms of the yield by 100 basis points, and corporate bonds and other bonds were to go up by an extra 100 basis points to compensate for higher risk premia, you would have an 8% decline in the value of global bond portfolios, and this is about $4 trillion. So we're talking about big money here.
So I guess the key question is, what can policymakers do to support economic risk-taking and keep financial excesses under control?
I think that economic policymakers need to be alert and need to act now. In terms of enhancing economic risk-taking, in addition to policies like structural reforms and smart fiscal policies that can enhance the capacity of the economy to grow and fill output gaps, you need financial policies to unclog the credit transmission mechanism, helping banks become more muscular to provide the needed flow of credit to the economy. And that's something which is particularly the case in Europe. But in addition to that, which is key to support economic risk-taking and thus growth, you need to ensure financial stability by keeping financial excesses under control. And that means that policymakers need to be attentive to the risks which are developing, I would say also including the shadow banking, and very focused on the issue of market illiquidity risk. So there is a need to put in place micro and macro prudential policies to avoid sort of market runs or liquidity market runs, and at the same time ask the question, what if they were to happen? What needs to be put in place in order to avoid problems from becoming too big to handle at a later stage?
Mr. Viñals, thank you very much.
Thank you.